Stocks are off of the session lows. The U.S. economy added fewer jobs than expected during the August month here that was tracked, while the unemployment rate ticked lower. Friday's report comes amid an ongoing debate over how severely the Fed should cut interest rates at its meeting later this month. For more on what the latest data means for you and your portfolio, we've got Lydia Boussour, who is EY's Senior Economist here. Lydia, great to have you here on the program with us. So what does this signal to you about the type or the depth of a cut that we could get or see from the FOMC?
Yeah, so the jobs report this morning essentially showed that the labor market is gradually softening, but is not falling off a cliff. You had moderate growth in payrolls. You had that slight decline in the unemployment rate. You also had the rebound in hours worked. All of these factors point to a labor market that's gradually softening. You didn't see the type of broad labor market deterioration that would have led the Federal Reserve to potentially implement a 50 basis point rate cut. So in terms of the size of the rate cuts, we remain in the camp that the Federal Reserve will implement a 25 basis point rate cut and will opt for that gradual approach with a steady pace of decreases throughout the remainder of the year. So three 25 basis point rate cuts by the end of the year.
So what does that set up for what the terminal rate as they get into that cutting cycle could look like here?
Yeah, there is a lot of uncertainty surrounding the pace of rate cuts as we head into 2025. As you know, we have the elections and a lot of uncertainty in terms of the post-election landscape. Right now, given our baseline for economic growth to fall below trend in the coming quarters and then gradually rebound in 2025, given our expectations for the disinflationary backdrop to continue and given our expectations for the labor market to soften but not deteriorate materially and fall into a deeper downturn, we're expecting 125 basis point of rate cut next year and a continued moderation, towards a little bit below 3% for the terminal rate. But there is a lot of uncertainty surrounding the pace of this easing cycle as we head into 2025.
Just lastly, while we have you here, Lydia, one of the other, of course, major data points that the Fed looks at is inflation and their dual mandate. And we're going to get CPI out next week. At what type of weighting, essentially, do you believe that the Fed is giving employment versus inflation at this juncture?
I think inflation and the inflation readings that we're going to get are going to be important, but it's also important to take a step back from these, all these data points and really look at the overall backdrop. If we look at the overall inflation picture, we've seen a lot of progress on the inflation front, and we remain in a disinflation environment when we look at this labor market that has rebalanced, when we look at final demand that has slowed as well, and more disinflation coming on the housing front as well. So all of these, disinflationary factors are going to keep inflation, we think, on that disinflation trend. So really the focus right now is more on the labor market, in my view, even though Fed policymakers are going to continue monitoring the inflation data. But overall, given the fact that the economy is still advancing at a modest to moderate pace, around 2%, given that inflation has moderated significantly and that the risk to the labor market outlook has increased, I think we're all set for that 25 basis point rate cut and that gradual pace of easing going forward.
Lydia Boussour, who is the Senior Economist at EY. Thank you so much for taking the time here today. We appreciate it.
Thank you.
Certainly.